Hello all and welcome back. I believe what I have is a very interesting show today. Now, today we're going to summarize and discuss the macro data that we just received this past week, and we're going to dive into how partisan politics is having an impact on the perceptions about how the U.S. economy is doing overall. Now, we'll also look into Intel earnings, and we'll see if we can get any sort of like read through to Nvidia or AMD and what they're going to give us on their earnings call. And then after that, we'll quickly discuss Microsoft and Facebook's earnings and see if we can get any sort of read through to Amazon's earnings, which is going to come like a day after, I believe, Facebook reports. And then finally, we'll look at a position that I completely sold out of this past week, and then what I bought with the money from that position. But before we get into any of that, here's an internet first. Netflix to stream WWE's Raw starting next year. This deal will allow Netflix to tap into WWE intellectual property. There, I did it. I managed to squeeze the words WWE and intellectual into the same sentence. Someone give me a prize. All right, before we get started, I'd like to thank Bob for his continued support. I also got a few new subscribers this week at Preston and Ben and J. Paul Fredericks. Thanks a lot for that, you guys. J. Paul Fredericks, he has a finance blog. I'll leave a link in the description. His latest blog was about another YouTube's financial product. It's like a value investing product called Stock Unlock. Go ahead and check it out. I'll leave a link in the description. All right, so the GDP results came out this past Thursday, and what it showed was that the United States economy was growing at a pretty nice rate, much higher than what was expected. It expected to be growing at 2%. It was growing at 3.3%. So that was better than expected. And then on Friday, there was a PCE inflation print that came out and showed that inflation was slowing even faster than was expected. So the economy is growing faster than it's expected. Inflation is coming down faster than it's expected. And if you take out, say, the food and energy component, which is what the Fed likes to do, they've already achieved their target rate because they're trying to get to 2%. And if you extrapolate that over the past 6 months, they're below 2%. So they've hit their inflation targets a lot quicker than people think. And the GDP is going up. But because they hit this inflation target, the thought is that maybe they're going to cut rates in March because the fight against inflation is essentially over, and they would maybe want until March just to make sure that it's actually, you know, they've squashed it. Now, it would be probably one of the first times that the economy has been humming along like this, that you're going to go ahead and cut rates. I say among the first time because I believe this also happened in like 1995, but there were a lot of foreclosures on houses in 1995, but maybe that's why they cut interest rates then. But nevertheless, they're thinking that they're going to cut interest rates here this year, even though the economy is humming along, and that's going to boost the markets. And for all of this, you know, the market is sitting at an all-time high. And what's crazy is this bull market's been going since what, like October of 2022. So somehow the markets have been able to get ahead of this and kind of like sniff out all of this positive economic, you know, data and actually go up. And now we're sitting here at all-time highs. I just think it's just completely uncanny that the market is smart enough to be able to do something like that. Now, there are a couple things that people point to say that the economy isn't particularly good. One of the things, of course, is that the cost of goods has gone up. And a lot of these goods, these are staples. These are things that we need. This is milk, this is eggs, this is bread, and that sort of thing. And these are things we need, and it's gone. These prices have gone up, and they're not coming back down. So that's one thing that people will point out to, saying, "Hey, maybe this economy isn't so hot, and maybe wages aren't able to keep up with this inflation." But we'll have a look at that a little bit later in this video, see if that's actually true or not. But another thing that they point out is credit card delinquencies. If like things are so good, how come credit card delinquencies are rising to the rate that they are? Well, Capital One actually released their earnings this past week. And what this does is gives us a little bit of a read through to the like lower income earner, because a lot of their customer base is from the lower income. So let's go ahead and see if the lower income earner really is having credit card delinquencies and charge-offs to the rate that it should be kind of scary to us or like alarming at this time. Now, here's a copy of the earnings call transcript from Capital One. And with regard to delinquencies, which of course they had to ask about, what they said was, since August, our monthly delinquency rate has been moving in line with normal seasonality and at stable rates relative to the same months in 2018 and 2019. And at this point, we have a pretty good window into January as delinquency entries in December indicate continuing delinquency rate stability in January. We've always said that delinquencies are the leading indicator of where charge-offs are going. Charge-off rate tends to follow delinquency rate by about 3 to 6 months. Based on the stability we've seen in our delinquencies since August and extrapolating from our current delinquency inventories and flow rates, we believe the charge-off rate is stabilizing now and settling out to about 15% above 2019 levels. So what that did for the stock of Capital One is it actually it set it up pretty good, like ding, it went up a little bit here, but you can see over the past month that it's up only about 6%. But the earnings call gave some optimism to the credit card industry. Also, this past week, Dow and McCormick, they reported their earnings, and what they said was that lower wage consumers, their pocketbooks were being squeezed, and it's having an impact on the revenue of those two companies, and it actually affected the forecast that they had for 2024 was basically because the lower wage consumer can't quite afford their products at this time. And that's true. I mean, there are a lot of consumer staples out there that, like I said before, that are going up, and it is putting a pinch on a lot of people's pocketbooks. And those prices, they're not coming back down. They're just going to be going up at a slower rate. If someone was paying $3 for a dozen eggs a few years ago, and now they're paying $3.20, and next year they're paying $3.25, but they want it to go back to $3. It's not going back to $3. All that's going to happen is the rate of inflation is going to go up a lot less. However, people's wages are going up, and we'll show that a little bit later on in this video, how much, our wages keeping up with inflation. Now, one of the things that kind of rubs me a little bit the wrong way is they say that the reason why this economy is producing at such a nice rate is because that there's there's leftover stimulus money, like the $1,000 somebody got 3 years ago. They've still got some of that laying around, and that's what they're spending, and that's what's keeping this economy propped up. And I don't know who they know that saves money like that, but I find it hard to believe that $1,000 given to somebody in 2020 isn't gone today. Maybe it is still there and kicking around, but I'm just saying that I think that it's probably gone. And in reality, the thing that's actually keeping this economy going is the fact that there's a low unemployment rate and that real wages are managing to keep up with inflation. So it's really impressive to me that we were essentially on economic life support in 2020. I mean, everything was shut down, and to go from there in 2020 to where we are today is quite an impressive feat, if you ask me. Now, admittedly, it is better in the US than it is, say, in a lot of other places around the world, but right now we're talking about the US stock exchange and the US economy. And for all this, I do believe that the Fed does deserve some credit for a lot of this, but really I have to give credit to just the business world and the way that they were able to quickly adapt to this quickly changing environment and come out on the other end in good shape. And really it's the capitalist structure that I believe deserves the lion's share of the credit for this turnaround. It's not the Fed, it's not government, it's basically just it's the entrepreneurial spirit and the fight of the average business person that's actually kept this economy going. All right, so all indicators point to a strong economy and an economy that's getting stronger by the day. However, there are a lot of people who just insist that the economy is shaky. In fact, they think that it is as bad today as it was at the bottom of the Great Recession, when unemployment rate was like 8.5%, when home repossessions were at the highest rate since like 1995. People were getting their homes repossessed left, right, and center. And there's a sect of people that believe that the economy today is as bad as it was then. And why is this? Well, in my opinion, it's related to partisan politics and like partisan political news sources. So let's go ahead and have a look at this chart. This is kind of crazy to me. So this chart here, it comes from the Michigan Consumer Sentiment Survey. And what it does is it surveys what people think of the current economic conditions. And this one's separated by a political party, where the green would be the Republicans and the red would be the Democrats. And you can see that through time, these have, generally speaking, followed each other pretty closely. I would say here during the Trump years, the green line was a little bit higher than the red line, but the red line was still high. And then over here now, the green line is well below the red line. As a matter of fact, this division between this red dot and this green dot is the highest ever. And what they're saying is that this green dot here is the lowest sentiment since March of 2009. This would indicate that Republicans today feel that the economic condition, at least their sentiment, is as bad today as it was when we had 8.5% unemployment and sky-high repossessions of your house. Now, I was kind of wondering why this might be. So I thought maybe it is that the Republicans, in fact, are worse off. If you identify as a Republican, you're maybe worse off financially than someone who identifies as Democrat. Now, for the record, about 25% of the United States identifies as Republican. About another 25% identifies as Democrat. And the other 50% identify as independent. I myself, I am a registered independent. I can't vote. I couldn't vote in most state primaries. I wouldn't be allowed because I'm not registered in either party. But I thought that maybe those that identify as Republican, maybe they're just on really hard times. So I looked up this Pew Research study, and what it shows is that that's not the case at all. That the Republicans are doing really well. You can see lower than 30,000. You can see they're mostly Democrat, and it's roughly even here. And I would say it's skews slightly to Republican in $100,000 or more, income earners. So it's not that they're doing worse financially, and it could be that the survey itself is just wrong. That's not correct. But I tend to think that they're through the media that they consume, that I think that study probably is correct, that they do probably feel that things are worse than they are. And to illustrate this point, I'm going to show you a quick video. It's with a very conservative commentator from CNBC. His name is Joe Kernan. I don't know the man personally, but I can just judge by the way that he's talking and the way that he conducts himself, like every day on his television show, that he's very, very conservative. If you asked him what he identified as, he'd say, I identify as a Republican. And so he asked these questions of a couple of these like political / economic type of strategists or pundits. Questions, and you can kind of tell that the way that he tailors his questions is kind of for a really, like they're gotcha questions, but these guys are very skilled at kind of like defusing these questions and kind of giving it a very like nonpartisan bent and something that's just very matter of fact. So let's go ahead and look at this video, and then afterwards we'll kind of discuss things that were said in this video.
Join us now to talk about the candidates' economic agendas and their chances today. Hoover Institution fellow Lanhee Chen, he served as policy director on Mitt Romney's presidential campaign, and Brookings Institution economic policy director Ben Harris. I'll just start with you, Lanhee. I saw in some of your notes that there is a lag effect for the economy. And perhaps, in your view, Biden's numbers on his handling of the economy between now and the election, you think that there's a chance that those start to improve because they should be better?
Yeah, I mean, certainly how people reflect how they feel about the economy should be better. I mean, we're still seeing a lot of measures of economic anxiety. I think people don't feel great about the economy, even though the measures objectively demonstrate an economy that's in a pretty good place. It's possible that voters will revise their assessments as we move toward the summer and fall. But, you know, there's some other measures that I think if you're the Biden campaign, you're worried about. You're worried about the fact that you have more Americans than ever since the pandemic working multiple jobs, for example. There are measures that you look at and you say, you know, you kind of understand why people don't feel so great about this economy. So their hope has to be that there is some impact on how people actually feel, because you can't tell people how to feel about the economy. They feel how they feel about the economy.
That's not stopping them from trying, Ben. I hear it every day with the guests that we have on that say, you don't know how you feel. And I always say, Ben, and you correct me if I'm wrong, if real wage gains didn't start growing until May of last year, so, you know, at least 2 years into the presidency, and if your buying power is still below where it was when President Biden took office, can't you feel that when you go to the grocery store, that prices are up 30%, my wages are not?
Yeah, so I'm glad you brought up inflation. I mean, inflation over 2023 outside of housing is below 2%. And Lonnie is right. I think that you start to see consumer confidence go up with a lag, and you saw a big boost over the past 2 months in terms of consumer confidence. It does feel like perceptions are changing around an economy. The labor market is still red hot and looks like it's in great shape. So while I agree that there are certain aspects of the economy that people should be concerned about, overall, between the labor market and calming inflation and continued economic growth, this is really a good news story, and you're starting to see that in the consumer sentiment.
Lon, you know, when it goes up in 2023, disinflation, it drops to plus 3%. That doesn't erase the 2022 and 2021 increases. And I think that's part of the problem. If you look at total inflation in a lot of things you buy in the grocery, it's 30%. And people remember, 2.5, 3 years ago, wasn't that long ago. So if you go and your grocery bill is 30% more than it was, that's why people are feeling the way they feel.
Yeah, no, I think you're absolutely right. And, you know, I was in New Hampshire over the weekend and had a chance to talk to some people up there. And look, the point they make is, sure, you know, we're being told inflation's getting better, but it's not like that loaf of bread I'm paying, you know, $5 for now is going to be $4 tomorrow. The fact that it's $5.05 as opposed to $5.25 doesn't make me feel any better as a voter, right? So I do think that is the concern for the Biden team, is that even though the numbers do reflect that some of this is softening, you know, people feel how they feel, and they remember not that long ago, to your point, that things were not as expensive, and they naturally blame the incumbent for that.
Right. Hey, Ben, prior to the pandemic, people point out, and surprisingly, we were in Davos, we had Jamie Dimon on, who made the point that prior to the pandemic, Trump was growing the economy pretty well, and that certain things were successful. I think he viewed the tax cuts as successful. But you had real wage gains, big historic wage gains with very low inflation. Stock market went up at quite a bit since Election Day, which a lot of people didn't think. And the unemployment rate was at a similar, not quite as low as it is now, but historic gains in employment as well, all without inflation. Do you think that's part of the reason that this election might be close?
Yeah, that's a great question. So it's unclear whether or not voters are going to compare the state of the economy in 2024 to the state of the economy in 2020 and make a decision based on that, or whether or not they're going to make a decision based on the policy agenda of the candidates or potentially something else. I mean, you brought up the Trump tax cuts. From my view, the TCJA was a signature legislation passed by the Trump administration. It's interesting. If you go to the Trump website, there's no mention of the corporate tax cut. He brings up opportunity zones, which were 1/1000th of the overall cost of the bill, but doesn't talk about that signature tax cut. But I think that you're right to bring up that question. You know, will voters compare the Trump economy to the Biden economy, which I think is pretty similar, or will they compare their policy agendas, which could not be more different?
That's a mistake, Lon, but it doesn't surprise me with a populist Yeah, I would cut corporate tax rates to zero. So I would say it loud and say it proud. You can tax the individuals that work at the corporations. This is we're competing globally. Our corporations, are they not? Why don't we want them to succeed, Lonnie?
Well, look, Joe, this gets back to the challenge in the Republican Party, which is it's a different Republican Party now than even was, 4 years ago. And the agenda of the Trump team is decidedly more populist. You see much more of that language. For many, many years, Republicans were making the point about fiscal responsibility, entitlement reform. You hear Nikki Haley talking about that. You don't hear Donald Trump talking about it because it's not a populist theme. A lot of people are not interested in entitlement reform in the electorate right now. So it reflects a shift in the Republican Party. It reflects a shift in sentiment amongst Republicans. But I think generally, if you look at a general election electorate looking toward November, I think the thought is, to take the most populist line you can. That doesn't put you in a bad place. And I think that's what the Trump team's been trying to do.
Okay.
So Joe Kernan does bring up some very good points and definitely some legitimate concerns for the incumbent party. All right, so you might have noticed in that video that Joe kept alluding to the 30% rise in consumer goods. And it's true that prices are going up and they're never coming back down. But let's go ahead and have a look at this calculator that comes from the Bureau of Labor Statistics to see exactly how much have things gone up since January of 2021. So here's the CPI inflation calculator. You can get this just by Googling Bureau of Labor Statistics CPI calculator, and it pops up and it takes you over to the government website. And what it does is it allows you, I'll move this down here, it allows you to pick some dates and to see what the inflation is at one time versus another. And up here you put in, say, $1, and we would say that $1 in January 2021 it takes $1.17 to buy what a dollar would buy in January 2021. And this was current as of December 2023. So I don't know about the 30% inflation. I'm sure some things are up 30%, but by and large, it looks like some things aren't up as high as that and some things are. So it's, according to this BLS calculator, it takes $1.17 to buy what a dollar would have bought back in January 2021. So let's go ahead and look at the what it was during the Trump presidency. That would have been what, January 2017 through January of 2021, and see how much that went up. And I imagine it's going to be less because we didn't have a pandemic. Yeah, so it's up 8 cents versus 17 cents. So the inflation, we would say, was roughly half, and the unemployment rate was pretty equivalent. But again, we had the pandemic, shut everything down, threw in all this stimulus, and it caused a lot of inflation, and something that we've been able to bounce back from. But let's go ahead and see what the wage growth has been like over that same period here. And this is the wage growth between January 2020 to December 2023. And in that video, Joe Kernan said that it went up starting in May of this year. So for like the last 6 months, we've had wage growth that has outpaced inflation. And in fact, it's before that. It's actually since March, So for like the last, 9 months, the wage gain has been outpacing inflation. And what Lonnie said in that last video was that given enough time, as you get closer to, say, the election time, and you give this another 8 or 9 months to run, that it's possible that consumer sentiment might actually start coming around in favor of the incumbent party. And that all remains to be seen. Don't really know. But that, I believe, what he's alluding to, and it does seem that the important part is it does seem that inflation is being outpaced by wage gains. Now, you'll notice in that video that Joe Kernan continued to reference, and this is a popular thing that happens in the media, prior to the pandemic, or he keeps comparing 2019 to 2024. And like I said, this does seem to be a common thing amongst a lot of media pundits, but the current administration didn't take office until January of 2021. That they weren't in power in 2019. So I feel that comparing 2019 to 2024, in my opinion, is a very unfair comparison if we're going to make that comparison like in a political context, which I believe that Joe Kernan was doing. Now, in my opinion, it's fine to make the comparison of 2019 to 2024 on a purely economic level if we're trying to, gauge how the individual businesses are doing within the economic community. But I don't think comparing 2019 to 2024, like in a politically charged way, is very fair. Now, to his credit, the Brookings Institute guy quickly talked him back and said, "Hey, listen. So what you're doing is you're comparing the economy in 2020 to 2024." And that the economy now is basically the same as it was, say, in 2018 or 2019 or during the Trump years. And for me, that's a reflection of the resiliency of the capitalist system and the strength of the average business person to navigate, say, difficult situations, and really has basically nothing to do with politics. It's kind of independent of the government. I mean, actually, if you could put a political party on me, and if there was such a thing, I would be what was called a registered capitalist. I think that's part of the reason why the United States does seem to be outperforming much of the world right now, outside of maybe Japan, because the United States is just more capitalist. And it's not to say there's something wrong with, having, a lot of these socialist type structures and like these quality of life things in place, but it does mean that the capitalist structure, I do think from something like this pandemic, is going to bounce back a little bit quicker. And in fact, that is what we're seeing, I think. All right, enough on that. I probably beat that to death, but I had to get that off my chest. All right, let's go ahead and switch gears and then have a review of Intel's earnings and see if we can pick up a read through to what Nvidia and AMD might be reporting on their earnings. So Intel Corp, they reported their earnings last week, and you can see it happened about right here, and it slammed straight down. And we need to know what is it they said, or what was it that they turned in, and should this be a concern to the likes of Nvidia and AMD? Did it actually impact Nvidia and AMD at all? Let's go ahead and do a comparison here. Now you can see when Intel reported their results, it affected them very, very little. So it hasn't happened yet. And that might be because of there's not a lot of read through that you can get between the Intel earnings and the Nvidia and AMD earnings. Matter of fact, let's go ahead and look what might have sent this Intel stock down, but the reason why Nvidia and AMD didn't quite collapse. So it showed that Intel stock sinks more than 10% as early 2024 outlook comes up short. So it was their guidance is what actually sank this stock. Because if you look at their actual quarter that they just turned in, what they turned in was 54 cents adjusted versus 45 cents expected. And they actually beat on revenue as well, or what they call top line, 15.4 billion versus 15.15 billion expected. So as they beat on the top line and on the bottom line, why is it that the stock would go down so much? Well, the answer has to do with their forecast, and their CEO Pat Gelsinger got on the earnings call, and he mentioned that demand for PC chips had normalized. We're hearing this word a lot lately. The economy does seem to be normalizing, and that sales were strong in the gaming and commercial sectors. Now, Nvidia and AMD are very big players in the gaming and commercial sector. So we would expect that Nvidia and AMD would have nice growth in these two sectors. Intel's second biggest division, data center and AI, saw sales decline 10% to 4 billion. That unit includes server CPUs and just PC CPUs. Now, this is the problem that this might be like just for Intel, because what it does seem is that this sales decline of 10% in a normalized economic environment might indicate that they're just losing market share to AMD and Nvidia's server chips. So AMD's server chip is the EPYC server processor, and so they're losing market share to AMD. This would be why, as a matter of fact, AMD shouldn't come down at all. It should have gone up a little bit on this news. And then Nvidia has their Grace CPU with their ARM architecture. And these are used it's a very powerful CPU that's also used in data centers. Now, I remember a while ago when Nvidia was going to team up with ARM here. They were going to acquire ARM in this big deal. And I had Nvidia stock at that time, and it just didn't go through, and the stock price didn't go up as what I'd hoped it would. But in fact, it came down a little bit. And who blocked this takeover here in February of 2022? Oh, it was the U.S. Federal Trade Commission and led by Lena Khan. And then here, uh, like a little while later, Lena Khan went after Amazon, saying that it's a monopoly. And now what she's saying is that she's looking into uh, launching an inquiry into AI deals by Amazon and Microsoft over, say, OpenAI and Anthropic. And so I started thinking, the only stocks I ever seem to own are Nvidia and Amazon, and she just constantly got my stocks under attack. And I'm like, did I ever do something? Like, I had to look and see, did I ever date her? Or is like, why does she hate me? And I've never dated her. That's official. I She's much too young for me, but I don't know. Everybody, I guess, needs to have an enemy, and I'm supposing that she's like been a thorn in my side. Let's put it that way. I'm not liking what she's doing to my uh, stock portfolio. But anyway, I digress. So later on this week, we're going to have earnings from Microsoft, Meta, and Amazon. The Microsoft earnings are going to be released on the 30th of January. And the Meta and the Amazon earnings are both going to be scheduled for the 1st of February. I really wish that the Meta earnings were scheduled a little bit ahead of Amazon, because I'd like to get some read through on the advertising sector of Amazon. I suspect Meta's advertising is going to be normalized and everything's going to be fine, and so will Amazon's. But at least we're going to get some read through on Microsoft's cloud computing sector, Microsoft Azure, and that will give us a little bit of insight as to how we might expect Amazon Web Services to perform. Now, Amazon Web Services has been expanding out to Japan, so I think it's going to do quite well, actually. But anyway, this will give us a little bit of a window. If that Microsoft Azure isn't particularly strong, I might sell some pretty aggressive calls against my Amazon position here. And the stock that ended up selling out of this past week was actually ITB. It's actually the home construction ETF. And the reason why it went down this much is because we had all of that strong economic data. And that might sound counterintuitive, but because of the strong economic data, the chances of rate cuts has come way down. So I'm going to take a gamble. I'm going to get out of this position for now. And what I ended up doing was I ended up buying more Amazon with the money that I had wrapped up in this ETF. And the reason why I'm taking a chance is because with every little itty bitty rate decrease that happens in the federal funds rate, or rather in the 30-year home loan, this thing is like a coiled spring. It comes down like a 0.25%, then this thing goes right up, because they're like, oh, everyone's going to buy a house now. So I think that the housing market is kind of like a coiled spring right now. And it's one that when they do start cutting rates, I'm going to get into that thing as fast as possible. I'm not going to catch that first little bit, I guess, but I think that when they start cutting rates, and I think it will be the first in a series of rate cuts, this thing should steadily start marching upwards. But for now, I'm willing to miss that first little bit. All right, well, that's going to do it for this week, everybody. I thank everybody for sticking around and for subscribing to the channel. If you got anything out of the channel, please like, subscribe, hit that little notification bell. Until then, we'll see you next week, and have a great day. Bye.